Good morning from Los Angeles. How is everyone? Welcome to Power Hour. I was going to say Friday edition, but there is no more Friday or Monday edition. It's Power Hour, period. Every Friday, let's see, 10 a.m. Pacific, 1 p.m. Eastern. Um, we stopped doing it Mondays and Fridays, just Fridays now, but going longer. First of all, let's take care of some business. Thank you for the support. Channel is growing. The last video did really well. But please subscribe if you're not. Turn on all notifications. And, this is like going to be a grassroots kind of a campaign. So, tell your friends, relatives, it's good education, okay? And laying the groundwork for much better things in the future. We're new. We're only like, I think, 6 weeks old. For 6 weeks, I think it's doing pretty well. A little bit more business. I have a website, www.sergioavidian.com. Please go subscribe to the free newsletter in there. There's a subscribe area. All it requires your email, and I will start sending out financial news or newsletters or my opinion on certain things, free, obviously. And that should start going out probably by the end of the month or first week of July. We're just setting that up, the topics, etc. It's free newsletter. You guys will learn quite a bit, or keep up at least with the happenings around the globe and the US as well. So today we're going to talk about 5 or 6 topics. Then we're going to I'm going to go through my little Robinhood account update, then, go through some questions. So save your questions to the last half hour or so. And then, I'll share my screen, obviously, if you guys have any questions about specific issues. And my weekly watch list, which I have amended, took out a couple of things, took some losses this week. But you got to take losses. Without losses, there is no gains. You got to let the gains run. Market keeps just grinding higher, obviously. But we'll talk all about that shortly. So subscribe to the newsletter, please. www.sergioavidian.com. And here we go. So, also the market recap is going to be done at the end of the week. That's why we're doing it on Fridays. So to start with, I'm going to go into, I'm on Twitter, so you guys should follow me on Twitter. I'm pretty active on Twitter. So what happened this week, right? This week, the headline of this segment is, Fed's playing with fire, right? You guys know I'm not a huge fan of the Fed or the Treasury or Washington, D.C. So, the market's at all-time highs, and Fed is discussing cutting interest rates. Never seen it before, but I guess they know something. My inkling is that we had a major inflation number that came out on Wednesday, and market took off, made all-time highs, obviously, and keeps grinding higher and making all-time highs pretty much on a daily basis. When I say market, I'm talking about the S&P 500 and the NASDAQ. What's happening is that literally like 5 stocks are holding the whole thing up. If you guys look at something called advanced decline lines, literally 50% of the stocks on the S&P 500 are under their 50-day moving average. I've never seen that before. I mean, very rarely that happens. So the rally that we're experiencing is not a broad-based rally. It's just literally like those 5 stocks. Apple obviously had an amazing week. Nvidia continues to chug along, new high every day, pretty much. Money is being thrown into these, Mag 7 stocks. I talked about it last week. So, the topic is going to be Fed's risky move. Are market gains justified or a bubble waiting to burst? So you guys know my bias has been negative so far. The trend is your friend, right? You can't argue with the trend. The market's telling you something. It may be right, it may be wrong, but at the moment, it is right. But let's recap our good old Fed. So what happened this week on Wednesday? Obviously, the interest rate decision came around, and Fed said, we're just going to only cut rates once this year. The expectation at the start of the year, when the market was 20% lower, was that they were going to cut the rates 3 times this year. So what they did is they pushed the interest rate cuts to 2025. They only said we're going to cut the rates only once. And I would have expected, a different outcome when it comes to the markets, right? Because the expectations are getting pushed out. Well, why is the Fed not cutting rates, right? The Fed is not cutting rates because inflation is not dead. They're really worried about it, that it could come back. So before they lower inflation to a certain target level that they have, they're not going to cut rates, they said. In fact, this is from Twitter. I follow these people, by the way. Kobesi letter. It's really, really good. They put out really, short and to the point tweets. And, I couldn't have summarized this better. That's why I put it up. So Fed chair, obviously, after the interest rate decision and the inflation numbers on Wednesday, does his monthly news conference, with journalists, financial journalists, etc. And so he literally said that he does not have a definitive answer as to why people are not happy with the economy. And he said that all of the data is strong regarding the economy. We have an economy growing at a solid pace. Do you guys agree or disagree with Chairman Powell? I think there is a massive disconnect between these people and the average American. I feel really, really that economy is not strong for the average American. For the top 1-2%, absolutely is. And then why is there such a big disconnect between data and reality? Great summary of what I could say. Well, reality is that the average American is suffering due to inflation, and it is man-made, by the way. It was created by the Fed because of their printing machines, constantly printing trillions and trillions of dollars, adding into the deficit. But besides that, created inflation. Inflation's, simple explanation is too many dollars chasing too few goods. It's not from an economy book, but that's in layman's terms, that's what inflation is. And they created all these dollars, threw it into the economy during the COVID crisis, and now they're trying to suck it back out. We had inflation over 6%, 7% every single year for the last 2-3 years. So, well, what does that mean? That means the average American is getting hurt. It's like inflation is like a tax hike on the average American. Everything we buy, we're paying more and more and more. And the reason, by the way, the market's going higher is because all the companies that we deal with on a daily basis, like, from Costco all the way down to gas, all the way down to maintenance, all the way down to housing costs, all of this, right? The companies that we deal with have raised prices. Are they going to lower the prices? I have never seen it before. What happens is that they raise the prices on everything and they keep it up there. And what happens? That goes directly to their bottom line, because their costs on the back end are not going up as much as they're raising prices, right? So that's why the earnings estimates are going up on the market, because, the average American is paying 30, 40, 50% more for pretty much everything that they buy. And do you all think that they're going to lower prices, these companies? No, I've never seen it. What happens is that they get to a certain level, they cut it down a little bit, few percentage points, and then they keep it there. That's the new normal. So that's why there is such a big disconnect between data and reality. Data, they can shove it wherever the sun don't shine. According to the data, unemployment is low. According to the data, inflation is coming down. All that data, right? And how does that relate to the average American, though? It doesn't, right? That's reality. And that's why these people have, between the Fed and the DC crowd, the massive disconnect, right? And the summary of his news conference is very well done. So this is his summary. Inflation has eased substantially, but remains too high. I mean, if that's not an oxymoron, I don't know what it is, right? How can you say that in one sentence, speaking both sides out of your mouth, Mr. Powell? Inflation has eased, but substantially, meaning a lot, right? From the 5, 6, 7% that we experienced last couple of years, but it still remains too high because their target rate is 2%. Well, in order to get it 2%, they have to keep the rates high. But that's the second tax hike on the average American, because we all have credit cards, we all have mortgages, we all have car loans. Well, what has happened to those things? They have gone up exponentially, literally, right? So, the first punch by the, lawmakers and the Fed was, yeah, let's pump money, save the economy through COVID, and then create the inflation. That was the first punch, the 1-2, basically. The second one was, okay, well, now we got to keep inflation. We'll have to raise rates from zero policy of 15 years to 5%, where everything we, spend money on, as far as interest rates are concerned, has gone up substantially, right? So that's the second punch. So you guys figured that out. We're like a ping pong ball going between the DC crowd and, the Fed. But Fed is following, fiscal policy. Monetary policy follows fiscal policy. And because Washington, D.C. doesn't have their house in order, right? That's what the Fed is doing. So Fed reasserts long-term inflation target of 2%. Well, good luck on that one. In order to do that, we need to keep rates high, but keeping the rates high is crippling the average American. I mean, there is no ifs and buts about it, because I can see it in the data. They talk about data. Credit card defaults are at an all-time high, right? Car loan defaults are at an all-time high. Why is that? Well, that's because the Fed raised the rates, okay? And since our economy is based on consumer spending, what's going to happen to all these credit card spending, right? Spend and tax, tax and spend. This is where we end up. This was an interesting comment by Mr. Powell. He said, strong pace of immigration has boosted labor market participation. We talk about that on the other channel quite a bit. He's basically saying that all these immigrants that have flooded into this country, illegally mostly, they're saying that, they're keeping the labor costs of the equation low. Yeah, because they're working for nothing, right? And another point he made, the Fed says the unemployment rate remains low. Okay. So the Fed's mandate is, people, 2%. So they're trying to manage something called soft landing with all this, management of interest rates and money supply. What they're doing is they're trying to create the soft landing. How many times we had soft landing in the history of this country? Here, that's it, 2 right there. And that wasn't even soft landing. But what happens is that their mandate is 2% inflation, which we're going to not get there for a while, low unemployment, and strong GDP. Well, those don't work together, okay? If you have strong GDP, inflation is going to stay high. That means you have to keep interest rates high, right, for longer. So, all these things that they put out, to the average American, does that apply? Not really. Unemployment remains low. Okay. He said that, but then unemployment last week hit 4%, which is the highest we've had probably for about 16 months now. So unemployment is ticking up. Well, that remains to be seen. Economic outlook is uncertain, and Fed is attentive to risks. I mean, look at all these comments by this guy, right? I mean, talk about word salad here. Talking both sides out of the mouth. First one, inflation has eased substantially, but remains still too high. Okay. This one, the fifth one, economic outlook is uncertain, and Fed is attentive to risks. Then why are you not lowering the interest rates, sir? I don't know. Yeah, because you created the bubble, and now it's really difficult to lower interest rates. And Fed needs greater confidence that inflation is headed to 2%. So all of this, to me, is garbage, mumbo jumbo, but markets like it. Markets like uncertainty, and it's just walking up the wall of worry, as we call it. So I mean, that's pretty much what happened this week. Fed kept the rally going in the markets, and and for the foreseeable future, the Wall Street gurus have decided, yep, we're in a soft landing situation. Everything is fine. Cooler heads will prevail. We'll just keep going higher. I'm like, okay, cool. So on this segment, on the next segment, the headline of the segment is, Washington is in fiscal chaos, right? We talk about it tax and spend situation. We talk about the deficits. We're literally, people, we're adding $1 trillion to the deficit every 100 days. Think about this. Okay, think about this. I mean, I am just not sure how this is going to work out. Where is this going to end? What are we doing here, right? Why are we mortgaging our kids' future, right? Okay, well, so talking about the future, this is another gentleman that I follow, Sven Hendrik, on Twitter. I mean, this was a rant, and I absolutely agree with every single word in this rant on Twitter again. He calls the Fed the geniuses. So he was like, he goes, what prompted the geniuses at the Fed to buy 1.7 trillion MBS's mortgage-backed securities during a pandemic supply-constrained housing market, causing massive housing price inflation, remains an unaccounted for question. 100%. After that, they ripped rates higher to kill inflation because they created the inflation, trying to fix their idiocy, making housing even more affordable. Well, we know what has happened to our rents, right? Most of us rent, but we also know that our housing values have gone through the roof. Why? Because inflation and hard asset values go up during inflation as an inflation hedge. And the constrained supply even further as people stayed and locked in lower rates, right? Like I have a low mortgage rate. I will, if I sell my house today and take the equity gain in it, the next house that I'm going to buy, I have to pay 7% mortgage versus my 3% 30-year fixed. My payments are going to go through the roof. There's not a way, there's not a day that I think about it. Should I take all this equity that I've gained over the last, 15 years? But then where am I going to go? The next place I'm going to go is not going to be cheaper as far as the price of the house. And also the interest rate that I'm going to pay on a mortgage is going to be 7% versus 3.5%. I can't afford 7% mortgage on a house. Okay. And so, I mean, this is the best part of it. They caused this with 15 years of overly easy money policies, leaving an entire generation of young people priced out of the housing market. 100,000% correct. And imagine, okay, if you graduated or if you're in your 30s, your wife and yourself have a job, you're working. Do you even have the down payment? Because every house in California, which I'm at, is like, even the Matchbox homes are like $1 million now, right? We need 200,000 minimum to do that, and then you're going to get into a jumbo loan at 7%. How can you afford that? How is that possible, right? So, you're starting life, creating a family. There's not a chance you can get into the house. But if you're renting, we know what has happened to rents as well. And now they're whining about inflation being still too high, the very inflation they caused and are causing still. 100% agree. What does it actually take for Fed officials to get fired given the immense damage they have caused? I said that on the last segment. When is this gonna hit, their head that what they're doing is just, besides kicking the can down the road, they're pricing everybody out of new housing. Rents have gone through the roof. Everything, they created inflation and now they're trying to kill it. It's just not going to work. It's not working. So, and when are these people going to get this through their head? But then their data is fine. I'm like, okay, well, their data, my house is not run by their data. If I had their budget situation in DC and the Fed, I'll be broke like 10 times over by now. I should have probably declared bankruptcy. And I said this, US is a bankrupt country. You guys like it? You don't like it? It's tough. You guys, US is basically a much bigger version of Greece. The only thing, the saving grace we have, which is, we're going to talk in the next couple of segments, is because we are the world's reserve currency. We were the petrodollar currency, which we're going to talk about that. I mean, that's the only saving grace we have, because we can keep printing money. We can keep spending and printing money. What does it actually take for Fed officials to get fired, right? Just like he says. Why is society still putting up with these unelected dilettantes? Yes, you guys know Fed is appointed by the president, right? And they're supposed to be non-biased. They're supposed to not take sides. They're just supposed to take care of the average American by regulating rates, creating money, or deducting money from the economy. Their job is not political, supposedly. Do you guys believe it? Do you guys believe that the Fed is going to, in an election year, make things go sideways? That's why market keeps going up, right? Election years, markets are always solid. And God forbid, I don't know what's going to happen after the election. Whoever wins, I think market's just going to tank. But that's my opinion again. So this was the best quote, though, out of all his rant. The biggest irony here that the largest driver of remaining inflation is rents, which are largely driven by Fed keeping rates higher for longer, as supply-demand imbalances resulted from years of ZIRP. ZIRP is zero interest rate policy. And this is from the Fed, Federal Reserve Economic Data, which you guys can see online, which I talked about in the past, where you guys can find it. So take a look at that chart, right? There is the red line. The red line is the federal funds target. Look what has happened to interest rates. You guys see that? For 10 years, it was zero. And then we had this spike to 5%, right? And at the same time, Fed is trying to, and the blue line is their balance sheet, how much money they have pumped into the economy 2-3 times. Obviously, through the 2008 financial crisis was the first spike. Then they tried to level off. It didn't work out. Then the European crisis came. They had to pump money. And then the last pump was in the tune of 6 trillion was during COVID. Look at this, right? Now they're trying to raise rates at the same time, lower their balance sheet. And the irony is the market keeps making new highs, right? And if you guys, have a picture in your head of the S&P 500 during times where rates are high and the Fed is trying to cut their balance sheet or lower the balance sheet, they have about a $9 trillion balance sheet now. Markets have not done well, but they keep doing well. And so to me, I'm puzzled as much as anybody. None of this is applying to what I've learned at school in my econ classes. And I mean, I don't know where this is going to end up, but I'm hoping that it doesn't end up ugly again. But at the moment, Fed says everything is fine. At the moment, they're saying they're working on lowering inflation, which should help the American consumer, which should help them spend more money, while their credit card defaults are going through the roof. I don't know. A lot of mixed signals this week. I'm kind of puzzled as anybody else. The next topic I'm going to talk about is going to be, my favorite deficit. When we create these deficits, okay, that deficit has to get funded somehow. How does that get funded? That gets funded by the Fed issuing IOUs. And the popular video last week was China is selling our treasuries, our IOUs, and buying gold, right? So what is when you're adding $1 trillion to every 100 days to your deficit, that deficit has to get funded. Okay, so the deficit starts with the fiscal problem in DC, right? Because they can't balance the budget, just like I balance my budget every month in my house. But these people cannot balance the budget to save their life. There have been attempts in the past, but it's not working now. Whichever side it is, the Democrats or the Republicans, they just like spending money because it's not their money, it's your money. But what they have done is the monetary policy is forcing fiscal policy to issue more debt. They have to balance the budget by issuing more IOUs, okay? And the US government is spending as if we were in a crisis. It's very true. So look at this chart on the right-hand side. You guys see the circles with the spikes? This chart goes back to, by the way, 1790s. It goes to the Civil War era, okay? Because once in a while you have to look at the bigger picture of what's happening. All these spikes are circled and how much the government had to spend money to come out of that crisis, okay? The one in the 1860s is the Civil War. The government had to pump 14%. extend the spending 14% to save the economy out of the abyss. The second one was World War I, 24%. Okay. The third one, spending. This is spending going up, right? The third one was World War II, 44%. Okay. We're at the levels, and then after the crisis is over, this money is spent. Obviously, it goes into the economy, and then the economy comes back. There's certain stability period until the next crisis, which was the great financial crisis. Okay. At the moment, we are spending. Okay, our GDP is close to I think 7 trillion. But what we're doing now, the spending, the percentage to the GDP or compared to the GDP is running at 44%. During COVID, it went up to 54%, right? This is how the deficits are getting created. This is how much money we have to spend to keep things going, right? Look at that chart, right? We are at the moment, our spending compared to the GDP, US government expenditures as percentage of GDP hit 43%. Okay. During COVID, it went as high as 54%. Think about this, people. Our total production of this country is about $7 trillion, what the economy produces, all the states as a federal government. We're taking almost half of that and spending it. And we have the budget deficits to boot on top of that. How is this going to end? Is it going to end well? Are we going to keep doing this forever until somebody wakes up and says, hey, man, what are we doing here? But, maybe it's only me. Maybe I'm the dumb one in the room, right? I mean, this is not talked about. This is talked about in a lot of circles. But, it's like, what have you done for me lately works in this country. We have just short-term memories. As long as we have our new iPhones every 2 years, and then a new large screen TV so we can watch the Super Bowl or football games, I'm good. I'm like, no, you guys got to think a little deeper than that. So that's what I'm trying to do. Just kind of warn things that are just about to go sideways. And I hope it never does happen. But this cannot continue. So let's put this in perspective, right? Spending as percentage of GDP is just 1% below World War II levels. And World War II levels, we know what happened there, right? Let's not forget the life loss, obviously. But, in every war, like the Iraqi war, let's say, how many trillions did we spend on it? And what happened with that? Where are we with that? So wars are created and wars are fought with immense amount of pressure on the economy because we have to produce, we have to obviously buy weapons, we have to improve our defense. But in a good economic time, right? I understand crises, but in a good economic time that the Fed says we're in, why are we still spending so much money? This is the time to cut spending. No, we're not doing it. Even at the peak of World War I, US government spending as percentage of GDP was 20 percentage points lower than what it is now. And I understand the economy is larger, but then this is a percentage of GDP. The country is always producing more, right? We're up to 7 trillion GDP, gross domestic product. That's the output of the economy. Why do we keep spending half of it? I have no idea. God knows. And while the Chairman Powell is saying, yeah, we're going to do the soft landing and the economic data is strong. Okay, well, then this is the time to put your house in order. If the economy is strong, right, stop the spending. You don't have to spend 40% of your GDP. Just spend maybe 20% of your GDP. Take it back down to the World War I levels of 24%. No, they're not going to do it. Of course not. And so, I mean, to me, this continues, right? Now, I started with the deficit situation, right? This deficit is an IOU. It's a loan, right? People are around the world, globe, which Chinese are cutting their exposure now. The Russians are as well. What's happening is that because of the deficit, we have to issue these IOUs called bonds, okay? And these bonds carry a coupon. Coupon is the interest rate on the bond. We have to pay interest. Just like when we go to a bank to get a car loan or a mortgage, we have to pay interest. There's no free meals, right? Well, this is the same thing with the US government. Now, you guys have to understand, when the Fed raised the interest rates from 0 to 5%, they have to pay that 5% to whoever is the note holder or the bond holder, right? Okay. So that's called carrying cost. We have a interest cost on all this money that we're borrowing. Just like we go buy a car, we have a car loan. Well, US has $34 trillion of debt floating around the globe. A lot of it in the US in pension plans and 401ks and things like that. So when the rates went, they had to raise the rates to kill inflation, which we talked about. But when the rates go from 0 to 5%, the interest cost on this massive amount of debt that we have created has gone through the roof. Now, let's put that in perspective, okay? For the first time in history, annual interest payments on the US national debt, this is just the interest payment, okay? This is just like you have a mortgage, the first 20 years you pay interest only, and then you pay down the principal, okay? For the first time in history, annual interest payments on US national debt will overtake defense spending in 2024, according to the CBO. CBO is the budget office, right? It is projected that for the full fiscal year 2024, interest spending, just the interest spending, will hit $900 billion. Now think about this, people. That's almost $1 trillion in interest payment only that we're sending around the world. Okay? Now, if we did not have that 34 trillion, could we use that 900 billion to get the infrastructure of this country going, to get, to help the needy a little bit more? And look, I'm not political. I'm not Democrat or Republican. All I'm saying is that 34 trillion in debt is an anchor holding the economy back. If we didn't have that, our GDP would grow a lot faster, right? And everybody would prosper. But no, the powers to be decided that we need this debt. We need $35 trillion of debt. And just the interest payments on it is $900 billion a year, which is surpassing the defense budget of $600 billion. In Q1 2024, interest costs hit $1 trillion on an annualized basis, and were $29 billion higher than the defense outlays. Okay, it's not done yet. In the first 7 months of 2024, interest was also higher than spending on Medicaid, which people need, right? Medicare, which is the retired folks, right? Healthcare, and defense at $514 billion. How is this making any sense to anybody? I don't know. Maybe I must be the dumb one in the room, because I don't think anybody cares about any of this stuff except me. Maybe I worry too much. I shouldn't, probably. I just should go borrow money like the government and spend it on some garbage, okay? Meanwhile, in 2023, interest percentage of GDP was the highest in 25 years. U.S. government needs to lower interest rates more than ever. Do you guys understand now what's happening? They created inflation by pumping money. They had to, I guess. They created these deficits. Well, on these deficits, the interest payments are up to $1 trillion a year now. Well, when the rates went from 0 to 5%, that's what happened. When the rates were at 0%, the interest payments were very negligible, obviously. Well, now that they raised it to keep inflation, do you see how they're put themselves in a hard place in Iraq? Do you see what's happening here? Right? So, that's why they have, because we can't keep paying $1 trillion a year in interest, because that's going on top of the deficit. Because to pay that $1 trillion, how are we paying that $1 trillion? We're creating more money out of the blue to pay the interest. And then when the bonds mature, we have to float new bonds to replace those bonds. And those bonds are going to carry a 5% coupon as opposed to a 0% coupon. So bond auctions take place literally every single day in this country, from T-bills to T-notes to 10-year notes, 20-year notes, 30-year bonds, right? So all we're doing is basically adding to one side of the ledger. The cost of carrying that debt has gone through the roof. And that's why now the Fed is forced to lower rates, because we can't keep paying $1 trillion a year in interest, right? And at the same time, though, right, the stock market is an all-time high while the Fed is forced to cut rates. I mean, are we going to get a melt-up of melt-ups? Probably. I don't know. So, and this is wonderful, which is cohorts with the Fed, the Treasury. This is Janet Yellen, our Treasury Secretary. Look at this, what he says. Look what she says. Look at these people, okay? Treasury Secretary Janet Yellen says U.S. debt load is in a reasonable place. Huh? What? The debt going up $1 trillion every 100 days is a reasonable place? Janet Yellen? I'm not getting it. And then it says, she said, it's a reasonable place because it remains at current levels relative to GDP. We just looked at it. We're at close to 44%, Ms. Yellen, of GDP. What happens if the GDP slows down? What happens if we go into a recession? Then what percent of that, of GDP, is going to be that interest payments and the deficit? What do you think is going to be? Janet Yellen? Huh? Think about it. And meanwhile, U.S. debt is currently rising by 1 trillion. This is the T, people. I mean, how many zeros are in a trillion? 15? Every 100 days. Who's going to tell her? I'm telling her. Janet Yellen, stop the mockery. Get your shit together. Get your house in order. Start with DC. Clean this mess up over there. Because these people don't know. They see $1, they just grab it and spend it. This is all hocus pocus. This is all garbage. This is all Wall Street speak. This is not average American speak. So that's why I created this channel. Maybe I'll get some traction by talking the truth. I'm an average American. So is probably all of you who are watching and going to watch later. This is hocus pocus. I'm not buying any of this. Come talk to me. This does not apply to our lives, the average American's lives. Okay? So, with all due respect, Janet Yellen, the debt load is not in a reasonable place. It's absolutely ridiculously unreasonable. So, with that said, the next topic is going to be something that actually happened this week, and it involves Saudi Arabia. So, we had an agreement with the Saudis dating back to the 70s. I think it's 1974, if I'm not mistaken. So the Saudis agreed that all around the globe, okay, oil, which is their commodity, which is making them trillions and trillions of dollars, it's something called Petrodollar, but all oil transactions around the globe will be done in US dollars. That was an agreement, the Petrodollar agreement, okay? Well, guess what? That ended this week, people. And guess what the Saudis did? Saudis go, you know what? I'm not buying this hocus pocus dollar shit you guys have going over there. They go, so we're ending that agreement now. We're not going to renew that agreement. Now, oil is going to be bought and sold with yuans, with rubles, with Deutschmarks. So they go like, no, we're going to just let go of the petrodollar policy that we had for over 50 years. And I'm going like, okay, what is that going to create? Well, that's going to create a massive dislocation. Massive, right? Because all these other countries, the reason the dollar is the reserve currency of the world, all these other countries who need oil, they have to pay the Saudis in US dollars. Well, now the Saudis goes, no, just pay me with your local currency. We'll figure that out. So is this the start of dollar becoming an absolute toilet paper that it is? It is. We know that with inflation, right? So is this the start of something big when it comes to Saudis not renewing this agreement? And who else is going to do this? Now, are the Chinese going to say, yeah, that's while we're selling your notes anyway, we're just kind of walking away from US dollar holdings because we think our currency will survive? Because until now, US dollar was king. Around the globe, everybody wanted dollars. Well, this is a big hit, people. You guys got to pay attention to this, okay? So, see, in yuans and euros. Yeah, the Saudis go, after all we have done for the Saudis, we saved your asses from Saddam Hussein. If it wasn't for us and spending 50,000 lives lost, young people died for what? For this, right? Iraqi war, $1, $2 trillions of dollars spent, right? I mean, so you guys can do this now? That say, yeah, you know, we just don't need you now. I'm like, well, you know, I don't know. Karma is a bitch, but look, I don't blame the Saudis, by the way, at all, because they're going like, okay, we're doing all these transactions in U.S. dollars. We're basically keeping the U.S. dollar together, and all the countries who needs the U.S. dollars to pay us in petrodollars when they buy oil from us, which is practically the whole globe, that's propping up the US dollar because there's so much demand for US dollars around the globe because all this trillions of dollars in petrodollars are floating. And then the Saudis go, wait a minute, I don't think we need dollars anymore. I think we just need, you know, local currencies we can handle. I'm like, okay. So Saudi Arabia will now sell oil in multiple currencies, right? Including the Chinese renminbi, euros, yen, yuan, instead of exclusively US dollars. This is this week. This wasn't talked about a lot in the news, right? And I'm going like, how is this not important? This is like crazy important. Does this mean the end of the dollar as reserve currency of the world? Potentially, but then we're always on a delay because I read a lot of these things on the spot and I can just make up my mind of what this could cause and this could create. You know, in the US dollar in a in a multipolar world, we know what's happening in Ukraine, right? We're supporting Ukraine and Russia don't like it. You know, we're there are rumors that China is about to go take over Taiwan. I'm going like, okay, that'll be the end of everything. And then we have all these conflicts going on. We have all these sanctions on China, right? I'm going like, what's happening here? Everybody's deserting the dollar. Everybody's selling their U.S. treasuries. I'm going like, who's going to buy these things? Because we can't buy it. The Fed is trying to lower the, you know, their holdings, right? They're trying to lower, you know, from 9 trillion. They're trying to lower their book. And who's going to buy all this stuff? Okay. So if everybody deserts, you know, leaves the dollar saying you just go take a hike or go take a long walk off a short pier, what's going to happen? Right. And I mean, this remains to be seen, but I have made some conclusions, which I'll talk about in the next few hours. This shows lack of confidence, right? This shows lack of confidence in the US dollar. And this shows confidence in local currencies like euros and yuans. And this goes to show where our administration is with all the, and again, it's not an anti-Biden thing, but when you put sanctions and don't expect any pushback, well, this is what you're going to get. Right? Who's the second largest producer on the planet when it comes to oil? Russia. Okay. Who's the largest producer in the world when it comes to natural gas? Russia. Well, we put the sanctions on them too because of the Ukraine war, that we're supporting Ukraine, sending billions of dollars to Ukraine. And then the Russia goes, okay, well, screw you, right? You do that, then what I'm going to do is I'm just going to relinquish the dollar as a petrodollar, and then I'm going to sell my oil and natural gas with the local currencies, right? So until probably, right? Until probably the Saudis need us again, right? You know, I'm sure there'll be some sort of conflict in there, military conflict, maybe at some point. And then they're going to come to the US. Oh, yeah, we just need your help. We need like more weapons. Or in fact, we need you to send some more troops down here to save our asses from these bad people that are about to come over and take us over. I'm going like, this is so sideways. This is horrible. Okay. But we'll see where this goes. Yeah, it was a 50-year deal. And the Saudis this week said, no more petrodollars. We'll just deal with everybody on their own. We don't need US dollars to do this. This could create actually more inflation because there is now all these unused, unneeded dollars that are floating around the world, around the globe, right? Because petrodollars are trillions and trillions of dollars. So I'm going like, well, where are all those dollars going to go, right? So you know, you got to start thinking about these things. And And this continues with that subject, right? Because if all those dollars are out there, okay, all these countries, right, sanctions or not, they want to get away from the dollar tit, okay? They don't want the dollar anymore. It's clear. It's pretty clear, okay? And few reasons for that. What are the reasons for that, right? The dollar has been the world's reserve currency since World War II, right? But a combination of political and economic reasons is slowly chipping away its supremacy. Absolutely. Nearly 60% of international reserves are held in dollar-denominated assets, such as bonds, all these things, right? Now, the sanctions against Russia, right, are, as well as China, right? These are not small economies, people, okay? I mean, they're going like, okay, screw your dollar. I don't want your dollar. You can shove it. And so when that goes away, watch out. Seriously, watch out. This is not the gloom and doom, but when the dollar loses its reserve currency status, then the whole world will figure out that the currency has been toilet paper anyway because of all the printing and spending. God forbid. Okay. But so U.S. monetary policy, number one reason, U.S. monetary policy holds too much sway over the rest of the world. Absolutely. The U.S. is the issuer of the world's reserve currency, which is also the dominant currency in international trade and payment systems, which is true. Basically, U.S. has been it. The dollar has been it. Now there is this push towards going away from the dollar, going to gold, going to Bitcoin. Like, it's not big enough, obviously, but a lot of alternatives are out there for people, for countries to go, okay, you know what? I had enough of this dollar shenanigans. I don't want any of this. I'm just going to go, deal with Russia, deal with Saudi Arabia when I'm buying oil with my own currency. And I don't blame them. I mean, we are it. We hold power because we move our rates up and down. What happens? The whole world, like we catch a cold, the whole world catches pneumonia. That's what happens. Everything depends on us. Well, militarily, it did. Well, we kind of lost that part. Now, economically, it seems like it's slipping away slowly. Now, the number two reason that everybody's kind of walking away from the dollar as the reserve currency is when there is so much demand for the US dollar. Like if, let's say I'm Venezuela, let's say I'm Argentina, let's say I'm these, some of these countries that need dollars because they need to do the trade in dollars and they need to buy oil in dollars, right? So there's constant demand from those countries and that props up the dollar because there is so much demand for the dollars. Well, what's happening is that it gains strength against all the currencies. Look what's happening with the Japanese yen. It's hitting a 30-year high at 157, 158 for the dollar. It was pretty stable about 120, 125, right? 125 yen for a dollar. Well, that's kind of, going out of the, out of style. So the greenback meaning the US dollar gaining strength against most currencies around the world is making imports far more expensive for emerging nations. Absolutely. Right? So if our dollar is getting stronger, that's also going to hurt us, by the way. A strong dollar is not a good thing because we do, believe it or not, we do export a lot of stuff, especially as far as high tech, IT, software, all that stuff, right? We do export quite a bit. We don't manufacture anything, but we do export a lot of that stuff. And for the buyer of that stuff, right, because of a strong dollar, it becomes more and more expensive for them to participate and create economic growth in their own country. For example, in Argentina, right? And the decline in their exports and the increasing prices in their imports is lowering their US dollar reserves, which is creating inflation in their own country. We know what's happening in Argentina, 80, 100% inflation a year. In Venezuela, all these other third world countries, right? Not that Argentina is third world. So now Argentina said, well, screw the dollar. I don't want to deal with the dollar anymore because it's way too expensive. And it's making the goods that I'm buying from the Chinese are, becoming way too expensive because the dollar is so strong. So what am I going to do? Okay, I'll just pay you in yuan. Okay. As opposed to the US dollar. Well, So the demand for the US dollar is going to go down. If the demand goes down on something, what happens to the supply? Supply is still massive. Demand goes down. What happens? Price of the dollar will go down. It will get weaker and weaker and weaker and weaker. And once it loses its, reserve currency status, toilet paper. That's what happens. And to sum it up, the third reason, again, the petrodollar risk that we talked about, Saudi Arabia, actually, see, the arrangement was formalized in 1945. That's 80 years ago, when the oil giant country Saudi Arabia and the US reached historical deal wherein Saudi Arabia would sell its own oil to America only using the dollar, and created the petrodollar, so everybody around the world would be using the dollar, right? And in return, Saudi Arabia would reinvest excess dollar reserves in U.S. treasuries and companies. See how this circle is kind of closing up on us now, right? Well, they're going to go now, well, we don't want to deal with the dollar. We don't want the trash currency of yours. And we're not going to buy the treasuries either. But at the same time, the Fed has to issue these IOUs. Who's going to buy these? Who's going to buy it? China is reducing their exposure. Japan is reducing their exposure. Russia is reducing treasury exposure. Saudi Arabia goes now, okay, we're not going to deal in dollars, so we just deal with other currencies. Who's going to buy this? Who's going to buy our bonds? That means, the fiscal policy that we have needs to put in order. Washington, okay? So, and summing up this topic is US dollar has been the world's reserve currency for decades, but its dominance is fading, correct? Sanctions against Russia have spurred other countries into considering backup currencies for trade. Correct. We've been talking about it for 45 minutes now. And U.S. monetary policy, the strong U.S. dollar. So the other thing that's happening here, people, if the Fed doesn't cut the rates, okay, figure this out. There's something called a carry trade, meaning in Japan, the rates are 1%. In the U.S., the rates are 5%, right? So what are all the hedge funds doing these days? They're going borrowing at 1% in Japan, coming back investing in the US at 5%. So that's sucking more, creating more demand for US assets, right? But then there is the reverse of that carry trade. What's the reverse of that? Well, when interest rates start going down, all that money is going to leave this country and it's going to create a vacuum, whoosh sound, which is not going to be good. But besides that, it's horrible for the Japanese economy. It's horrible. It's making everything more expensive. It's sucking dollars out of their economy. Japanese yen, because that Japanese yen that they borrow at 1% is being reinvested here at 5%. That's called the carry trade, right? That's why the Japanese yen is in the toilet. And the US dollar is gaining strength against it because of that interest rate differential, 1% to 5%. So, rates staying high in the US is not only bad for us, because we talked about the interest cost on our debt, right? It's also bad for emerging countries such as Japan's and Germany's, because our US dollar is being bought, but there's massive demand, right? Because what's happening is that if you go to Germany, in Germany, the bond rates for the similar duration are about 1.5%. In Japan, it's just hit 1%. Well, our rates are at 5%. So as a hedge fund, smart guy, I'll go borrow at 1% in Germany. I'll go borrow at 1% in Japan, come buy the US treasuries. But then there is the reverse of that. At some point, that trade is going to be unwound. It has to be, right? Then what happens? At the same time, if the US dollar loses its reserve currency status, when this trade is getting unwound, which is going to start happening if the Fed keeps cutting rates, right? So Fed keeping the rates unusually higher to kill domestic inflation is absolutely going to have global economic ramifications around the globe. So you guys have to start making, putting these dots together, which I do for you, so you don't have to. But so that's where we are. And let's do a quick update. This is one of my favorite people on this planet. This is a Bitcoin update. We cannot not talk about Bitcoin. Bitcoin has having a little bit of a drawdown. It got up to 72,000. That's about the 66, 67,000. It's still going in that range, right? Since March and middle of April, they had the halving, right? And usually the history has been that after a halving, it takes about 6 to 8 weeks for it to go sideways. Well, Bitcoin has been going between 65,000 and 72,000 for the last 3 months now, plus almost, right? So if you look at a Bitcoin chart, it's basic consolidation before it takes a leg up, as far as I'm concerned. Or is it a massive top that's about to absolutely get crushed? We're going to find out. Meanwhile, my second famous genius on the planet behind Elon Musk, Michael Saylor, just mortgaged more of his company. He just issued another $500 million of convertible bonds to go buy more Bitcoin. Now, I don't know. I mean, we did a good video called Michael Saylor, Gambler or Genius. I'm still in the genius camp, but if Bitcoin cracks, it goes down to 40, 30,000, he's going to be forced to sell Bitcoin, and that's going to add fuel to the fire. So this drama is going to unfold pretty shortly. It's either going to break out 72,000, go to the next leg, which is going to be 100, 110,000, or if it does crack, there's going to be a lot of forced selling. So the jury is still out. My opinion is consolidation going sideways because of this gentleman. His name is John Bollinger, and his technical tool is on every single one of my charts, called the Bollinger Bands. He is the creator of the Bollinger Bands. I respect him immensely, okay? And so his comments caught my eye this week, right? The volatility is actually shrinking on Bitcoin, right? It's going between 65 and 72, kind of sideways, right? So John Bollinger had an amazing response to a tweet. And the gentleman tweeted, he said, the longer we consolidate, the higher we'll go, which is my experience with consolidation periods. Remember, we talked about it, the bull, flagpole, and then we consolidate, and consolidating is gaining energy, right, for the next leg up. That's what usually happens on stocks or financial assets. That's how it goes. And John Bollinger responded with an amazing, tweet, and he said, "I wish I could remember the maxim: the bigger the base, the higher." Anyone? Exactly. All the weekly charts that I show you guys talk about it, right? I love bases. So either, and Bitcoin, the jury's out. Either this is a massive base that the next leg is going to come, or this is an absolutely massive top that the shit's going to hit the fan. I'm betting, the price will tell me what to do. If Bitcoin breaks 62,000-ish or so, it's going to take a dump. There's no doubt about it. Conversely, if it cracks above 72,000, it's going to go to the next level, which is 100 to 110K. So we're waiting. That's why 3 Ps, patience, position, and planning. But he's the guru, man. I mean, he's my man, and literally, he's like the only thing I have on my charts is the Bollinger Band, 20 EMA, 50 EMA, and 200 EMA. That's all I have. Naked charts, basically. His latest comments are in line with his previous predictions. About a month ago, when Bitcoin was trading near 70,000, Mr. Bollinger hinted at a possible price pullback, which it did, to 67,000, where it's currently trading. The key question is now whether Bitcoin will hold this level or see further changes. Well, the jury is out. That's the Bitcoin update. And all the other altcoins obviously are moving with Bitcoin, right? Everything moves in tandem in that world. So we'll see. And the Fed, by the way, was also affecting Bitcoin. I mean, the day the Fed said they're going to start cutting rates once this year and 3 more times in 2025, Bitcoin took off. So lower interest rates are friendly to Bitcoin, right? Because lower interest rate could bring inflation back, and Bitcoin is a pretty decent inflation hedge because you cannot make more than 21 million of these existing things. So, anyway, this is my little Robinhood account update. I started with $1,000. It went to 1189. Then it went to like 2,300. We're not putting it all. We're just putting like the second week, and this is as of last week, 2,086. So I was up about 100%. Okay. And this week, as of 9 a.m. today, I'm at 2640. I had a great week in this little baby account. So I made a new high. So I started with 1,000. Within 2 weeks, I was at 2,300. Then pulled back to 2,000. Remember when I showed you guys my big account, trading account, how it goes like stair step up. So this week it was like almost about a 30% gain. I'll still have 2 or 3 positions in there. So there's unrealized gains in there. So next week it may be, but then due to the show being at 10 o'clock or power hour being at 10 o'clock, I have to put something in there. And this is as of 9 a.m. Pacific time. So far, so good. Let's see if we can keep this account going. I mean, hopefully, we will keep growing. Will it be 30% a week? Absolutely not, because I just went double and then kind of went sideways, and then I took the next leg up. Hopefully, next week, next Friday, this will be at 3,000, and then just keep growing slowly. That's what I'm hoping for, and that's where we end. So I did pretty good, Chris. 11 o'clock. I finished all my topics. Let me put my trading screen on. So as I said, the market just keeps making new highs. I mean, there's no ifs and buts about it. And let me add this to the. Actually, you know what? Let's just answer some questions. Let's see if there are some questions highlighted. There's a couple. Melvin says, so what do you think about China selling off all the, well, they're not selling all. They were at 1.4 trillion. Now they're down to about 800 billion bonds and replacing them with gold reserves. Yeah, we talked about that. There is a video, Melvin. You should go watch that. It was like a crazy popular video last week for us anyway. 2,000 views, which is big for a little channel like us. Let's see what else. Let's read the comments a little bit. We need to refine an average American. Average American is you, sir, and me. Average American got diluted by so many immigrants and non-consumer immigrants generation. Okay, it's not political, but it is reality. Should we load on more gold? Well, if you think inflation is over, gold is one of the inflation hedges. Why? Right? If the Fed is saying that inflation is under control, do you believe it? If you don't believe it, then you should definitely load up on gold or Bitcoin. Okay. If you think it's over, then yeah, gold is going to suffer as well. But gold also will do well if the US loses its reserve currency status. So, I mean, look, over long periods of time, gold has not done as well as the stock market. That's a given. Okay. The stock market has done 9-10%. Gold has not done 9-10% because there is a lot of variables in gold. There is carrying costs like Bitcoin. You can just buy it on paper and keep it in your cold wallet. Gold, you have to have the bars, although you can do it through the ETFs, the GLD. I have a little bit of gold, but I'm not a huge fan. I rather invest my money in other places, such as real estate, because that keeps better pace with inflation, because you have control over your rent, right? You can raise the rent and create more cash flow out of it. Gold doesn't have cash flow. It even has carrying costs. Feds, when shit hits the fan, blame the people. Yes, that's what they do. They're good at it. Let's see. I'm stuck with my current home. Definitely will never do a sale. Yeah, we can't. I'm same here, Melvin. A ton of people are selling their houses in my town. I don't understand it. Yes, they want to pay cash for something cheaper, potentially, but then what is cheaper, right? You may have to. I mean, look, in the same town, you can't sell something like in my town in LA. I cannot sell my house today and buy something cheaper because everything has appreciated. Now, if you're like a, empty nester, your kids have left, you're only just husband and wife, let's say, yeah, then you can move from a house to a condo maybe or something. Yes, potentially. So Brian, not knowing what city you're in, I cannot make too much more of a comment on that. Yes, Melvin. Yeah, but who's going to hold the politicians accountable? Politicians have their own issues. How did they get in power? They spend presidential elections. We zoom. They spend hundreds of millions of dollars for a job that pays 480,000. I think it is what the president makes a year. Why do you think they do that? You know the answer to that. I don't have to. She's, yes, definitely on the touch. Game over, man. I don't know about game over, but a lot of things, a lot of moving pieces. No offense, you're not an average American. You own a home and have lots of money in the stock market. Okay. No, that is the average American, actually. In this day and age, I am an average American. I'm definitely upper middle class, I call myself. But I don't think I don't think I'm wealthy, but I'm content with what I have. And I don't know. Yeah, if you're talking about the average American who's working for a minimum wage, police street economy, yes, you may have a point there. Yeah, those people are absolutely suffering with all this disastrous policies that they created, um, the tax and spend and all that good stuff. So let me add my screen to. Okay, you guys can see this. So let's talk a little bit about our favorite GameStop. Well, no, actually, let's start with the market. Here is the market. Here is the triple Qs, the Nasdaq 100, which is getting pushed by obviously Nvidia, and Apple had a massive week. Apple just gained $350 billion in market cap in 1 week because during the announcement they said the magic two letters AI. So every company's earnings now has AI in it. AI. Well, we'll see where AI ends up. We'll see how this all turns out. So this is the triple Q, uptrend, intact, no ifs and buts and questions about it. I have a channel that I have drawn that I'm kind of watching. Here's the channel that goes back. Let's see, that goes back 2 years, maybe. Yeah. So here's the bottom. There's a bottom. You connect. That is your uptrend, and here's your upper trend channel, lower trend channel. At the moment, we're at the edge of the upper trend channel. Now, does that mean we're going to get a pullback? I don't know, but we're squeezing ourselves up there. There's another uptrend that was created. It was this one right here. You just connect once the market makes a higher high, you guys can connect the two lows. RSI is a little overbought short term, but doesn't mean really anything. Uptrend is intact. Is there a question that this is an uptrend? No. Yeah, market keeps grinding higher. This is, one thing that I want to talk about real quick is, remember guys, we've been talking about this for at least 2-3 weeks now. And there was this downtrend, on interest rates. This is the TLT. You guys can watch this. The chart, obviously. I had this channel drawn for months, going back to here. If you guys see my cursor, it's been going, rates have been going back and forth inside that channel until the previous week, not last week, right? What happened? Remember? In fact, if you guys go watch Power Hour from last week, that was the breakout that was happening, meaning interest rates are going lower. So when this chart goes up, that means interest rates are inverse correlation. So that means rates are going down. So rates started going down, pull back, and now rates are lower, right? The only thing we have is above the 200-day average now. This is saying that rates are going lower, and markets gaining more strength because of that probably as well. There is the only thing that's in its way now. There is a downtrend. There is this channel that I watch. The long-term downtrend is way up here. So that's going back 3, 4, 5 years right here. This is what has happened, right? This is zero interest rates up here. This is 5% down here. So upper left-hand corner is zero interest rates. That's during COVID times. They had to cut the rates to zero, obviously. And then the rates have been going up since, except that we had a little breakout here. The next one, resistance, is going to be in this highlighted channel that I'm highlighting. And everything is working out right now. Interest rates are going lower. That may create some housing activity. Market's going higher, and this is the S&P 500 right here. Uptrend, no question about it. Just goes up, goes sideways, creates a bull flag, goes up, goes sideways, creates a bull flag. Uptrend intact. No ifs and buts about it. No reason to question it. For me, it's really tough because my bias is negative, so I'm trying to stay out of trouble, not shorting the market. And everybody's favorite, Nvidia, up another 1.8% today. Don't forget this bar. The stock just keeps grinding higher every single day. It's a $3.3 trillion market capitalization now. The only thing that I'm kind of watching for Nvidia is that you guys have to understand how far away a stock can get away from its 200-day moving average. Right here was the highest point. Moving average was about 60, and it was as high as 100, almost 98. So that's about 60% above its 200-day average. At the moment, we're about 64% above the 200-day moving average. Stocks don't do this. I mean, this is Nvidia. This is not GameStop. Okay, so they did issue the 10-for-1 split, right? So this is the split price 132. That means pre-split it's $1,320. Figure it out. Amazing chart, amazing uptrend. Hasn't even had a 2% correction since it broke out again right about 90 or 900. All it does is just keeps grinding higher. It does a little correction, continuation pattern, and keeps going up. All power to it. Will it continue? For all the long sake, yes. Now, I updated my Tesla. Let's take a look at Tesla. A lot of people are asking me. It's down 4. As we know, Elon Musk got his $55 billion pay package approved. We talked about it last week. Tesla is still going sideways. Now it's trying to double bottom here. This is the support level right here. Still, jury's out. It's going to break one way or the other. That's why patience is necessary. Just waiting, not doing anything on Tesla. Apple had an absolutely barn burner blowout of. I mean, this is Apple. This is a $3 trillion company. Look at the move it took. It went from 195 to 220 in 2 days. It literally created $380 to $400 billion in market capitalization because they said the two magic words, and it made an all-time high. When a stock makes all-time high, see, you guys see this, all this period going sideways. Literally, Apple from July of 2023 all the way to now, it's been going sideways. Basically, it's just going up and down, up and down. It finally broke out. So is it going to take the next leg up? Probably. Technically, it should. It was resistance right here, right up here. Clear air. Nothing not to like about it. So let's go through a couple extra charts, and then I'll answer questions, and I'll say goodbye to you all. Well, let's look at everybody's favorite meme stock, GameStop. So GameStop had an interesting week. So did Roaring Kitty, aka Keith Gill. What did GameStop do? Well, when Roaring Kitty has $700 million of unrealized gains, he didn't sell. Okay. And then he goes, look, this is my YOLO trade. And 645,000 people watched him live in his live stream last week. And he said, this is my YOLO trade. This is the way I do it. It's not for everyone. YOLO meaning you only live once trade. And so far, all he did was he had 120,000 call options. June 20th, he exercised 40,000 of those. So at the moment, he owns 9 million shares of GameStop, right? He started, by the way, people, with $53,000 in 2019, 2020. 9 million shares of GameStop at the current price of 30, let's say, is 270 million. So his 53,000 turned into his YOLO trade, from 53,000 to $270 million. Pretty good deal, right? He's a believer. But what the company is doing, there's only one winner in this, by the way. There's a lot of bag holders in the stock, okay? But what's happening is that the company is the winner because the retail crowd is so into it. They're following this Roaring Kitty guy so religiously. He's like a cult leader now. Every time he tweets something, stock goes up 20%. They call themselves diamond hands, right? They don't sell. They promise they're never going to sell a share. Well, who's taking advantage of this? The company. Ryan Cohen, who's the CEO of the company. They just sold 75 million more shares of stock and collected $2.2 billion into their treasury. Now, GameStop has about $4.5 billion in cash. Okay, now let's make sense of this. There is 425 million shares outstanding now. Okay, so $10 out of the $28.74 that it exists is in cash now. So this company, with the retail help, propping the stock up and keeping it up here, has been selling shares. They literally have sold 110 million shares in the last month, right? The company is issuing shares. Now, they're diluting the shareholders. I don't think people understand this. What's happening is that, though, at the moment, at 420 million shares outstanding at, let's say, $30, the company is worth $12.5 billion. Well, okay. Now, 4.5 of it is cash. Is the business that's losing money, bleeding money every quarter, is it worth 8.5 million? Is the enterprise value worth 8.5 billion? No, but there are technical issues with this. There are a lot of people who are shorting this for it to go, to cash value probably, because the business is not making money. But now, GameStop cleaned up all their long-term debt. They are holding 4.5 billion cash. Are they going to go invest this money properly? Are they going to buy another company in the area? Not a brick and mortar, but convert the company from brick and mortar to an online entity potentially. Are they going to go the Michael Saylor way? Are they going to buy Bitcoin? I don't know. But certainly the retail in just this stock's case has helped GameStop flourish, literally. And the stock is 28.70 now. Roaring Kitty exercises options. He owns 9 million shares. He owns about 3% of the company. Retail owns a whole bunch of that 400 million shares, 20 million shares outstanding. And I mean, I don't know. It's a very interesting situation. If you talk bad about GameStop, I did one video, got 1,000 views. I think I got like 60 thumbs down because I said, "Hey, you bag holders, right? Why are you guys liking the stock so much?" Because I'm doing some fundamental analysis, right? And I'm going like, why? What is there to like about GameStop? It's losing money every quarter. What's so special about GameStop? It's a brick and mortar, video game seller. What's the big deal with this thing? And I got hammered. But then stock is $28, 28.5 bucks. I think it's overpriced, but then there is a lot of illegal shorting going on. A lot of shenanigans are going on with the stock, but Roaring Kitty is the man. Deep effing value, he calls himself on social media as well, and his name is Keith Gill. Look, man, you can't argue with success. 53,000 has turned into $250 million. How do you argue with that success? Like I said previously, I call my winners and losers. Alibaba, I got stopped out. Just like I said, I like the stock. It's absolutely broke down. I had bought the stock right about 80. My support was about 77, which was right here. When it took that out, sayonara, losing 4 points, getting out. If you guys bought it, you would have lost money with me. What else? Everything else, I'm gonna put the on my weekly watch list on the community page, as well as my little Robinhood account results at the moment. Uptrend continues. Will there be a pullback? Yeah, at some point, I'm pretty sure there will be. Is it imminent? I'm not sure, honestly. But all these things that I talked to you guys about, right? U.S. losing world currency status. Is it going to happen? Is it going to affect anything? I don't know. Time will tell. Let's see. Is the average American over their head in debt? Absolutely, right, Share Warrior Rick? Good question. Well, it is. I mean, that we are built on debt. On the government side, we're built on debt. On the average, if you call it average American, we just like spending money. We're an economy that depends on consumer spending. 80% of GDP is consumer spending in this country. So if consumers don't spend, there is no economy in the U.S. So they have to sell you some shit. Well, in order for you to buy the shit that you don't need, you need credit cards, right? Because just to the inflation, incomes in this country are down substantially over the last 30 years. Police Street says, I learned so much. Thank you, Police Street. I appreciate it. I know this is random, but you ever meet a hotshot Mexican Wall Streeter? I don't know, man. That's a little racist. Come on now. I am sure there is going to be. Talk about hotshot Wall Streeter. I'm continuing with my interviews of these amazing traders. Anthony Trudelli, who's an OG of OGs. I had 2 of them done already with Jack Barugian, who was one of the board members of the Chicago Mercantile Exchange from the days of behind to all this electronic trading, right? He helped create all that. Please go watch those. There's so much great advice in there. And Anthony Trudelli is another OG of trading. I'm going to interview him. I'm going to interview somebody from Roth MKM who I consult for. He's an amazing analyst. So those are going to continue in the channel. Another way of taxpayers save the company. Yes. Well, not taxpayers. No, retail. Taxpayers. We're all taxpayers. Yeah, the company, as far as I'm concerned, company is the only gainer. Look, obviously, Keith Gill made a fortune, right? There are winners, but then every time stock gets volatile, like, okay, for example, stock went from 10 to 60, and Keith Gill was up 700 million, and, he didn't sell, he's the diamond hands holder or whatever. I mean, he could have traded it, but then the next day stock hit 30. Well, if you bought it at 60, you're a bag holder, right? I mean, too bad. Or a lot of people swing options on these things. They all hit the wall. So, yeah, the company is the winner. Company keeps issuing shares. Company, since this saga started, company had 270 million shares outstanding. Today, they have 425 million shares outstanding. So company is the winner. Company keeps issuing shares because stock is held up at 27, 28, 30. I mean, company literally turned themselves from a shithole into a financially reasonably stable company. How many, they have 4.5 billion net cash on their balance sheet. Without retail doing what they did, they wouldn't have 4.5 billion cash. So I don't know. Is there any other questions? Let's see. Okay, no more questions. Okay, don't be shy now. Ask the questions. I have 10 more minutes, 8 more minutes. Trader interviews are awesome. Thank you, Police Street. There are more coming, more of them. I just want to do it with people who I really respect, and their knowledge goes so deep in this world. I even learned from them. So, any other questions, guys? Please don't hesitate. So let's recap. Every Friday, I'm here for about an hour and a half. Hour. Join me. Please spread the word. I think I'm doing good work. Every month I'm going to share my trading account. This month I'm taking a drawdown for sure, but let's see where I can end up. I will share that account, full transparency, which I did last month, and it's over there. William says Kava. I see a lot of good things on that. Yes. You know what? Let's look at Kava, William, because see, this is how you guys don't have to think too much about investing. Okay, here's Kava. Kava is like a Mediterranean version of Chipotle. Okay, what do you guys think? You guys think this is an uptrend or a downtrend? I mean, pretty clear uptrend, right? I'm going to give you guys something that actually, this was way before I started doing the channel. I ate a Kava first time right about here when the stock was $30 a share. Literally. Stock came public, went up a little bit, then came down all the way to 30 from 55, 60, and it based for about a month and a half or so, right? First time I ate a Kava was right about here, meaning, okay, I'll give you guys the date, about November of last year. I liked it so much, the concept, the taste, the flavor, everything about it, the simplicity, right? I'm not a huge fan of Chipotle. I don't like them, but I go, this is amazing. Are they public? So sure enough, while I'm eating, I looked at it and I bought the stock. I bought like a couple thousand shares at 32, right? And then it started going. I sold it too early. I doubled, okay? I sold it about 64. And then now stock is 90, right? I'm happy with my double. Don't get me wrong. But this is what you guys have to understand. You eat at these places. You go to Costco. You go to gas stations. These are the companies that you guys are dealing with on a daily basis. You don't need to be, a financial analyst to figure out. Every time you go to, I went to Kava after that, which was weekly because it became my favorite fast food joint. The lines were out the door. Every Kava that I went to, there was a line. Every time, all days, right? I'm going like, okay, well, this company is expanding. They just went public. They took the money. They're opening new restaurants. And every restaurant that I go to, in Pasadena, in LA, in Granada Hills, there are lines out the door. So that means it's not just location, right? People are trusting it, so you just go invest. Obviously, technically, it did the right things. It broke out, all that good stuff. But the point I'm trying to make is, keep it simple. Stupid works. No need to complicate things, right? You deal with all these companies, every one of us on a daily basis, right? So trust in those companies and deal with them, and it's easy to do, not too hard. Why is there such huge short interest in Kava? Is there? I don't know. I'll have to take a look at it. There is huge short interest in a lot of stocks. But hold on, you know what? I have like 5 more minutes. Let me look at it on my phone. If there is such a huge short interest on Kava, let's see. Maybe there are non-believers. There's also a huge short interest for getting ripped apart in Chipotle. Okay, let's see. Kava. Okay. All right. Let's see. We zoom if you're right. Stock is down 3 points today. Big deal. This is $90. Let's look at the statistics. Kava. Market cap is $10.5 billion. That's pretty decent, right? $10 billion company. All started with a little bit of an idea that, we're going to sell healthy version of Mediterranean Chipotle. Shares outstanding, 114 million shares. Float is 81. So, no, not really. I mean, the short interest was 11.5 million. It's about 10%. Conversely, on GameStop, the short interest is about 30%. So, Kava, no, not that sure, not that high. 10%, 8 to 10% is pretty average. And stock trades, millions of shares a day. So to cover, I don't think there's going to be that big of a short. This is not a short squeeze candidate. That's what I'm trying to say. Like GameStop is, or like some other stocks are. So with that said, stay healthy, stay safe, be well. Go to the website, sign up to the free newsletter, www.sergioavedian.com. I'm here every Friday. Send me your questions. If you have other questions, you can send it to Sergio@sergioavedian.com. That's my email address for my website. Is that Yahoo Finance? Yeah, Yahoo Finance is great. You can go to Yahoo Finance and with a little click on statistics and you'll get the snapshot of it. And they update every day. So yes, that's Yahoo Finance. Any other questions? No. All right. So I'm going to end it here. Like I said, see you next Friday. Please support the channel. Please put a thumbs up on the videos you watch. And again, if you have any other topic ideas, you guys want me to talk about other things, my email is Sergio@sergioavedian.com. Shoot me an email. Other than that, be safe, peace, make some money.